is 70%, but I guarantee you that if you look at that system, if you got the actual if you got the full trade station report from the person, rather than just the equity curve, where you see the profits are going up like this, like a rocket ship, and they say, hey, this thing wins 70% of the time. Instead of seeing that, if you saw the whole thing, or actually just the one tab, which you can see on the documents that are from the live event, you can see the trade analysis, and from there you can see how many winners and how many losers in a row you'll get. And what is amazing is that you will find, even with the 70% system, that you will get up to 7, possibly even 8 losses in a row. And it will still be a 70% system. 7 to 8 losses in a row. Now that flies in the face of what most people will expect. Most people will say, hey, if you have a 70% system, that means you're only going to lose 3 out of 10. It just doesn't work like that. Okay? So, now let me say this. If your system does turn out to be 65, 70, 75, 80, 85% accurate, then that's just gravy. But what if it's not? Okay, what if you're down here, 40%, 45%, 50%? We want to structure our trading in a way so that we're still going to make money. I mean, look at how much more money you're going to make if it really is as profitable as you think it is. So again, looking at the worst possible case here, that's what we want to look at, is what's the worst that can happen to us? How much money can we lose if we're really not trading very well at all? And of course, you can see if we start to flip this now, well, let's say we take off 3 at the beginning and then we let 7 run, of course, now we have a much better profit outlook, where we're letting more of the trade run to take a bigger profit. It really is that simple. So we've kind of taken a look at some very basic money management stuff. Let's take a look at the actual chart. Now you see here I've got some blue lines on the chart, and if you remember from our prior discussions, I was telling you that the average move from high to low for the last 2 years on the pound has been 140 pips, and that's taking 5 p.m. Eastern Time as the close every day. So it opens at then 5:01 p.m. Eastern Time. Basically, I guess you could say 5 p.m. in 1 second. The 5:01 Eastern Time, and then it closes again the very next day at 5 p.m. Eastern Time. So open to close, 140 pips. So let's go back to the trade. Okay, I put this blue line in place on the 5 o'clock hour. But let's do this. Let's move this down just a little bit. I'll move this down, keeping it on 5 o'clock. And I'm going to put this now at the high, roughly. Okay. So what am I doing? What I'm doing is marking off the actual range that I would expect for the day. And from this point, what I would expect is that this would now be the average range of the day. Oops, I don't know how that happened. Let me get this line straight across. There we go. Okay. So from the top here, so if this was the high, I would expect the low to be down here if the market goes down. Okay, so let's start off there. If the market goes down. So in the example I gave before of taking profits at 85 pips, let's take a look at this. If we shorted somewhere up here, let's say at 211.40, and we expected an average day, not less than average, not more than average, but just an average day, the market would move down to this line in order to reach that. So that's about 10:06, 10:07.